Right, welcome back. This is going to be part 2 of our income statement balance sheet introduction exercise. We completed part 1 where we used all the data to complete the income statement and the balance sheet, and we solved for the debt to find out the debt required to balance the balance sheet. Moving on to the data for year 2, let's copy that information. Let's come and bring it over here and let's use it to complete this year 2. All right, assume a 20% growth in the sales revenue. Great. So let's just put a 20% in there. And we're going to come here and say, take that sales over there, multiply it, open brackets, 1 plus 20%. Excel will convert the 20% to 0.2. It'll do the maths for us, and 10 will become 12. It's easy enough. Paint that green. Let's move on. Assume that the GP remains unchanged. All right. Oh, by the way, we changed that to 45% because I was messing with the numbers. So let's put that back to 50% so that those numbers update. Then let's say assume the GP remains unchanged. Let's put in there 50%. And we'll do this calculation here. It's the sales multiplied by our gross profit percentage. Therefore, 12 million minus 6 million will get us our cost of sales. Okay, process that one. Next up, try that again. The overhead expenses have increased by 25%. Okay. So we're going to take the 2 million and we're going to multiply this by open brackets 1 plus 25%. That's the same as multiplying by 1.25 to get our increase in expenses. Great. New fixed assets worth 2 million are purchased. The new fixed assets are depreciated at 20% per annum. All right. So let's do a little calculation here. Let's put the new fixed asset number there, 2 million. Let's give it some formatting, make it easier to read. Get rid of those zeros. And if this is 20%, well, what that means is the depreciation per year is 2 million times 20% is going to be 400,000 Rand for these new assets. But remember, we still have existing assets that are being depreciated at 1 million Rand a year. Okay, that came from the previous one. Here it was. So our depreciation here is going to be, let's put 1 million over there, format it, and let's say our depreciation here is going to be equal to the 1 million Rand there plus the 400,000 that we did here. And we'll come back and do the assets when we get there in the balance sheet. So now what we're going to do is we're going to say our gross profit minus the expenses minus the depreciation gets us a 2.1 million in operating profit. Okay, so this new assets, I'm not going to paint that green yet. The depreciation I'm going to paint green. Tax rate unchanged, dividend policy unchanged, credit sales 90%, customer payments, that's reduced, creditor days remains unchanged, cash is 5% of sales, 90% of the company taxes are paid by the end of the year. Now what that leaves us with here is a problem as to what is the interest expense. What is the interest expense? No information is given to us. Now what we're going to do here is we're going to find out what was the interest rate in the previous year and apply it to this year. in order to work that out, because there's no other methodology in order to do it. So we're going to assume that there is going to be some debt, but we don't know at this stage. So let's do this. Let's put in there 0. We'll find out if there's some debt. Then we will get an interest rate, and then we will calculate an interest expense after that. So for now, we can simply say profit minus interest gets us our profit there. This tax rate remained unchanged, so we can take that and we can multiply it by 28%. We use that. Do the maths there to get our new profit. The dividends remained unchanged, the dividend policy. So we're going to take this and we're going to multiply it by the dividend policy of 20%. There was the 20% we used, and therefore we are left with the retained earnings that we are going to carry to the balance sheet. All right, it doesn't say anything about new capital being issued, so I'm going to assume here that the share capital remains unchanged. Now this is going to be last year's retained earnings plus what comes out of the income statement, and the retained earnings grows. It's cumulative. Then what we can do here is we can copy that formula and paste it in there. It will add up our equity. All right, let's move on. New fixed assets. Okay, so we must take the existing assets. We must add to this the 2 million. Let's rather point to the number, the 2 million. Then we must subtract from this the depreciation that we have paid or been allocated to the income statement for the use of those assets. That gets us to 7.6 million. All right, so now we can paint that green. So it's done. All right, we've in fact used the tax rate. Let's mark that. The dividend remained unchanged. Let's mark that. Credit sales remain at 90%. All right. Here we go. Assume that the business has been able to reduce the payment days from customers to 60 days. We were using 90 earlier. So let's put in here 60. And now let's do the calculation for our, in fact, we don't have to do the calculation. We can copy that formula. We can put it here. All right. We need to be sure that we have this 90% in there as well. There we go. So if we make this 0, test the maths, then our debtor will go back to 0. Okay, make that 60 days. All right, so credit sales remain 90%. We've used that. We're now getting customers to pay us sooner. That's always going to be a good thing. Creditor days remains unchanged. Okay, creditor days remains unchanged. Let's calculate our creditors here, or in fact we can take that formula and we can put it there. It will work for us. It's taking that creditor days and it's taking that cost of sales. That's good news. And that means we've done that. What about the cash? That remains at 5%, so we can simply move that across and we can copy that formula and paste it in there. That will work. Higher cash because we've done more sales. All right. 90% of the taxes are paid by the end of the year. All right, so therefore the tax percentage, we can move that across. That's going to be the same. We can copy that formula, Control C, Control V, and test it that it's using 10% of those taxes over there. All good. Now we have the current liabilities, and it seems as though we're missing some important data here, because how long, what's our stock days? We had stock days back here of 45. Let's assume that the stock days, let's make this point number 13. Assume that the inventory days remain unchanged. Okay, and let's copy and paste that, and since we've made that 45, we can take that and paste it in there. All right, test it using 45 days. It should be taking the cost of sales up there. There we go, the cell in blue, and we have the inventory sorted. The accruals, I'm just going to leave that at 0. I can take the current assets calculation there, copy that, paste it there, and now Excel will calculate what's in that cell for me. And now let's repeat our net asset calculation. This helps to do this a few times so that you guys remember it. Fixed assets plus current assets minus current liabilities will get us to the net asset number. Remember, the total capital must equal the net assets. Great. Well, we definitely need some debt because we only have 8 million and a little bit of change there. So therefore the debt requirement in the next year is going to be the total capital minus the equity. All right. We've got some debt here at 1.4 million and some change, nearly 1.5 million. Now, by doing this debt calculation, what that means is we now have to calculate some interest and put it back in the income statement. Now, when we do the calculation of interest for the income statement, it's going to change our profitability, which is going to change our retained earnings, which is going to change this retained earnings, which is going to change our equity, which is going to change our debt. And if we change our debt, it's going to change the interest, which is going to change, which is going to change. And what I'm getting to here is this is a circular reference and creates complexity in our income statement. But nevertheless, let's try and do it. Let's see, what was the interest rate here? We can just do a little calculation off to the side. We can do this by saying take the interest and divide it by the amount of debt and convert this to a percentage. See if there's any decimal places on that. All right, so it's not an exact amount of interest. Let's make an assumption here. Let's assume that the interest rate is 10%. Okay, let's put that down here. Interest rate is 10%, and let's apply it to both years. And if our spreadsheet is working well, it should be able to manage this calculation. Okay, so I'm going to go back to the first year and I'm going to attempt to do this calculation there. All right, so we're going to come here to the interest expense and we're going to say, all right, well, take your debt and multiply it by the interest expense and put that in there. Okay, now immediately Excel is saying, uh-oh, circular reference in B10 because, well, I explained that earlier. So there's a neat little goodie that can help us here. So I'm going to go to File. I'm going to come down to Options. This menu is going to pop up here. I'm going to go to Formulas, and here under Calculation Options, there's a little box here for Enable Iterative Calculation. And an iterative calculation is going to help us solve this circular reference problem so that it does multiple calculations, maximum iterations 100, in order to find out what does that interest have to be. Let's go for it. Oh wow, that was fast. Okay, see what happened. It's now calculated the interest required based on the debt, it's adjusted the profitability, and it's been through this iteration enough times to get to an answer. So in fact, it's less interest based on 10%, and everything works out very nicely. Let's do the same in the next year. We actually can copy that formula now and paste it in there. 154,000 based on 1.54 million, that's 10% exactly. And now it's adjusted our retained earnings in the income statement and the balance sheet, and our circular reference problem has gone. Thank you to Excel for doing this for us. And there we are. We have completed the second year of data for our income statement balance sheet example. And let's pause this here, and in the next video I'm going to come back and I'm going to do some scenario analysis and a little bit of ratio analysis for this business.